Hey everyone, welcome back to Corporate Decoder, the place where we peel back the layers of corporate jargon. And today we've got a report that is packed with more ETFs than you can shake a stick at. Get ready because we're diving into the Tactical Advantage ETF's semi-annual shareholder report. Before we dive in, if you're all about getting the real story behind the numbers, make sure you hit that subscribe button. And for more exclusive discussions and to connect with other finance enthusiasts, join our Discord community linked in the description below. Alright, so what we have here is a formal shareholder report for Tidal Trust II, which houses the Tactical Advantage ETF, ticker symbol FDART. This report covers the period from the 1st of April 2025 to the 30th of September 2025. It's basically a check-in to let shareholders know how things have been going. The company is calling this a tailored shareholder report, which means they're trying to present the information in a way that is easier to digest. They want you to understand what is happening with your investment. Now, let's get to the juicy stuff, the financials. We see a total advisory fee of $103,696. This is the money being paid to the folks managing the fund. Keep that number in mind as we look at the overall size of the fund. The fund itself is valued at $34,969,000 or about $35 million. When you compare that $103,000 advisory fee to the $35 million fund size, it gives you a rough idea of the cost of management relative to the total assets. This fund lists 17 holdings for an ETF. This means it's investing in other exchange-traded funds, or ETFs as they're commonly known. They're not directly investing in individual stocks or bonds in most cases, but rather in baskets of these other funds. And get this, the portfolio turnover rate is a staggering 335%. That's incredibly high, even for an actively managed fund. It means they are buying and selling investments very frequently, which can lead to higher transaction costs and potentially higher taxes for shareholders. It suggests a very active trading strategy, perhaps trying to capitalize on short-term market movements. Looking at the investments, a massive 98.6% of the fund is invested in other exchange-traded funds. This is the core of their strategy, a fund of funds. Among the top holdings, we see things like the Spider Gold Minishares Trust, which is basically a way to invest in gold. Then we have sector-specific ETFs like the Technology Select Sector Spider Fund, the Communication Services Select Sector Spider Fund, the Industrial Select Sector Spider Fund, and the Financial Select Sector Spider Fund. They're also holding broad market ETFs like the Vanguard Growth ETF and the Vanguard Value ETF, which represent different investment styles. Plus, the iShares Convertible Bond ETF indicates some exposure to bonds with equity conversion options. Interestingly, they have the Global X Uranium ETF, suggesting some bet on the uranium market, and the Defiance Quantum ETF, pointing towards investments in companies involved in quantum computing. Now let's look at the performance. The net asset value per S-share, which is what each share of the fund is worth, stands at $22.42. This is up from $20.95 at the beginning of the period. So, on a per share basis, the fund has seen some growth. The total return for the period was 7.62%. While this number might seem respectable, remember that high turnover rate we talked about. That 335% turnover rate can eat into returns due to trading costs. And speaking of costs, the ratio of expenses to average net assets is 0.64%. This means that for every dollar invested, about 64 cents go towards the fund's operating expenses annually. This is a significant cost, especially since the fund is mainly investing in other ETFs that already have their own expense ratios. Let's peek at the statement of operations. For the 6 months ended the 30th of September 2025, the fund had dividend income of $337,485. Expenses for the period were $103,696, which matches that advisory fee we saw earlier. They reported a net realized loss of $304,940 from investments. This means they sold some investments for less than they paid for them. However, they saw a significant net change in unrealized appreciation of $2,559,152. This is essentially the increase in value of investments they still hold. It's the unrealized part because they haven't sold them yet. Putting it all together, the net increase in net assets resulting from operations for this 6-month period was $2,488,001. This shows a positive growth for the fund during this reporting time. When we look at the schedule of investments, the cost of the fund's investments is listed as $32,341,404. The current value of these investments is $34,952,890. This difference of about $2.6 million is the unrealized gain we saw on the statement of operations. There is also a small allocation to a money market fund, the First American Government Obligations Fund, yielding 4.05%. This is likely a place for cash that isn't actively deployed in their ETF strategy. The fact that this fund is heavily invested in other ETFs raises some questions, while ETFs offer diversification. Investing in a fund that then invests in other ETFs can lead to duplicated fees. You are paying the expense ratio for the Tactical Advantage ETF, and then you are also indirectly paying the expense ratios of all the underlying ETFs it holds. This can significantly drag down overall returns over time. The high 335% turnover rate also implies a very active and potentially costly trading strategy. They are constantly shifting their positions, which can rack up trading fees and potentially lead to capital gains taxes if positions are sold at a profit within the same year, given the high turnover and the fund of ETF structure. The primary risk here seems to be the potential for eroding returns due to layered fees and trading costs. While the fund did achieve a positive return in this period, it is crucial for investors to understand these costs and the active management strategy. The strategy appears to be aimed at capturing gains across various sectors and asset classes through other ETFs, but the efficiency of this approach is questionable with such high turnover and double layering of expenses. Alright, that is our deep dive into the Tactical Advantage ETF's semi-annual report. What's your take on this fund of funds approach and its high turnover? Do you think the costs are justified by the returns? Let us know your thoughts in the comments below. If you found this analysis valuable, please hit that like button. It really helps the channel. And of course, subscribe for more unfiltered corporate insights. Don't forget to check out our Discord community for more discussions. Thanks for watching, and we'll see you in the next one.